Good morning, ladies and gentlemen. On behalf of Capital Trust Research Private Limited, it gives me immense pleasure to welcome you to part 1 of our research webinar on the first quarter 2022 earnings update. Today's webinar will cover the tile sector stocks, Royal Ceramics PLC, Lanka Wall Tiles PLC, Lanka Tiles PLC, and SWISSTEK PLC, as well as textile sector stocks, Haley's Fabrics PLC, and TJ Lanka PLC. We hope you will understand that our earnings update presentations are very comprehensive. Therefore, we regret to inform you it was not practical to cover 10 companies in one session. However, we assure you we will not disappoint you, as we will have more time to do more detailed research and present to you next Saturday at the same time with valuable information on LOLC PLC, Brown's Investments PLC, Expo Lanka PLC, and DIP Products PLC. Capital Trust Securities is ranked number 1 for the first quarter of present financial year in terms of transaction turnover and brokerage turnover. It possesses probably the largest local client base in the Colombo Stock Exchange, as it had executed the largest number of transactions in the Colombo Stock Exchange last month. Today's webinar is the 13th of a continuous series of webinars that Capital Trust Holdings Group will be conducting on listed companies, the macroeconomy, market outlook, technical analysis, and real estate. Capital Trust Research Private Limited has been in the forefront in correctly identifying early high-growth stocks that have generated significant outperformance during pandemic conditions as a result of the continuous LKR depreciation and import restrictions. The stocks covered by its research reports and webinars have helped its clients to make over 150% returns year to date and kept the Colombo Stock Exchange very active. Now, we are pleased to introduce Mr. Hasitha Liyanage, Head of Research of Capital Trust Research Private Limited, and Mrs. Divyakasi Chetty, Head of Corporate Finance of Capital Trust Partners Private Limited, who will make the presentations. We will be happy to answer those questions you may have at the Q&A session. Thank you.
Good morning, everyone. Thank you, Prashani, for the introduction. Let us start off with this earnings update with the tile sector. Most of you have a good understanding of the tile market, considering we have done multiple presentations on the sector. As you know, imports of wall tiles and other ceramic tiles are still suspended, although the import ban on sanitary ware was lifted. As a result of the import ban, domestic manufacturers control close to 100% of the market at present. With regards to the current market shares of domestic manufacturers, the RCL group controls 72% of the market, with RCL brand controlling 32%, Tile having a market share of 32%, and LWL controlling 8%. MacTile controls the other 28%. MacTile's market share has increased within the quarter as a result of the change in strategy adopted by the RCL group. The reason for MacTile's market share increasing is the yield management strategy employed by RCL, LWL, and Tile. All three companies are moving away from low-margin smaller tile sizes, such as the 600 by 600 millimeter tiles and the 300 by 300 millimeter tiles. The RCL group is also looking to cater to higher margin, larger, more luxurious tiles of 1200 millimeter by 800 millimeter and 1000 millimeter by 600 millimeter sizes. These larger tiles are expected to command a 10 to 12% higher margin compared to the smaller tiles. Touching upon the market size of the tile segment, you might be aware that the demand for tiles decreased by 25% over the last few years compared to the 24.5 million square meter market size experienced in 2018-2019 levels. But due to the import ban, local manufacturers cannot meet the complete market demand at present, resulting in a demand-supply mismatch. We expect the market size to increase year on year in financial year 2022 in terms of the sales volume driven by residential demand as well as a few large-scale projects. Due to this reason, RCL, Tile, and LWL are all embarking on capacity increases to kick in by June 2022, which will make Sri Lanka self-sufficient in terms of satisfying even the 2018-2019 demand. The reason for the decision to invest in capacity enhancements was the additional comfort and protection obtained in the form of increases in cess rates applicable when the import ban is eventually lifted. The cess on tiles was increased from 50% or 183 rupees per square meter to 50% or 490 rupees per square meter, whatever is greater. This methodology of duties and cess doesn't allow for under-invoicing and creates a fair playing field for local manufacturers. The cess on sanitary ware was increased from 15% or 12 to 40 rupees per kilo to LKR 75 to 155 rupees per kilo. The increase in cess rates for the tiles and sanitary ware makes local manufacturers more competitive against importers. Now, let's move on to the risk associated with the tile sector. There are many investors wary of the risk associated with the sector. I would like to address each of these risks. One of the main risks highlighted by investors is the lifting of the import ban. Let's start off with the increase in cess rates, adding additional protection for the domestic manufacturers and eliminating under-invoicing. This is the most important factor for the domestic manufacturers. Next is the depreciation of the LKR, followed by the exponential increase in freight rates. For the above reasons, we don't consider the removal of the import ban as a risk, as importers won't be competitive compared to locally manufactured tiles. Currently, the tile companies have around 1 month's inventory, and at times even lower. This is compared to large build-up inventory the company had in the past. So the big concern for investors have at the moment is how will RCL group companies achieve similar results to last financial year. It is important to note, firstly, last year the production facility was closed for 2 months during the lockdown and another 10 weeks after due to the uncertainty associated with the economy. This year, the production facilities are running at full capacity and throughout the year. RCL also added an additional 400 square meters a day capacity last financial year. So in fact, we expect the companies to achieve higher sales volumes during financial year 2022 compared to financial year 2021. Even though we have conservatively assumed a decline in revenue in the tile segment across a few of the companies. In addition, the company management have adopted a strategy to move production towards a larger tile segment that commands an average 10 to 12% higher margins compared to smaller tiles. The company management have also brought forward the timelines associated with the implementation of the capacity enhancements from financial year 2024 to June 2022. In addition, RCL also implemented a 25% addition to the sanitary ware capacity late last year, incurring minimal capex. RCL will be adding 3,000 square meters a day capacity to its Horana plant by June 2022, incurring an investment of approximately 1.8 billion. RCL is also considering another 8,000 square meter day capacity addition at the Ahaliagoda facility at an investment of 4.5 billion. LWL will be implementing a 1,500 square meter day capacity addition in June 2022 at an investment of 1 billion. They are also exploring an additional 6,000 square meter day capacity addition in financial year 2024, dependent on the increase in the tile market size. Tile, on the other hand, is expected to implement a 1,200 square meter day capacity addition by June 2022, incurring an investment just under 1 billion rupees. Additional 4,800 square meter capacity addition is in the pipeline as phase 2 in financial year 2024. These capacity additions will ensure strong financial performance in financial year 2022 and financial year 2023 and ensure financial year 2021 results aren't one-off. Then there is an additional risk of price controls being implemented on the smaller basic tiles. Due to the change of the product mix explained earlier, we don't consider the RCL group being impacted by the same. In addition, the company hasn't increased prices for the last 4 years in the tile sector. The increase in retail prices have been made by agents and dealers. There is additional risk on cost escalations due to the LKR depreciation. The companies have experienced a 40% increase in LPG costs since December in rupee terms. Packing material costs have increased by 50%. The company is managing these cost escalations by implementing various cost efficiencies to offset the impact on margins. Through the cost saving initiatives and damage and reject reductions, the company should continue to save LKR 500 million in financial year 2022. Another concern for investors is the quarter-on-quarter decline in Q1 earnings that were concerns. That created concern that it would result in lower earnings in financial year 2022 compared to financial year 2021. It is important to understand this is cyclical nature of the tile sales and the tile industry. We will look at this element in more detail in the next slide. But having spoken to various outlets and channels, we estimate sales volumes in July 2021 to be 100% higher than July 2020. July 2020 was a month that included pent-up demand after the lockdown last year. Another risk considered by investors is the impact of lockdowns. Similar to the lockdown in Q1, the company earnings aren't expected to be affected by the lockdown that started today. The reason being, all three companies have prepaid forward orders amounting to 1 to 2 months. So with the production expected to continue, the company is expected to maintain its budgeted sales volume during the lockdown period. We expect even the forward order book to remain strong, with new orders flowing in similar to what happened in Q1. As you can see in the graphs, Q1 has historically been the worst performing quarter of the sector. This is expected due to the New Year's holidays and other holidays disrupting construction work in April each year. There has been Q-on-Q increases in earnings from Q2 to Q4 for all three companies, and this trend is expected to continue in financial year 22 and financial year 23. It is important to note that 1Q financial year 2022 earnings exceeded the 2Q financial 21 earnings, which had pent-up demand after the extended lockdowns as well. We expect 2Q financial year 2022 profits to exceed 2Q financial year 21 figures, as the sales generated in July 21 is estimated to be 100%, as we explained before. Now moving on to capacity expansions. As explained earlier, RCL, LW and TILE are all embarking on capacity expansions, which will go live by June 2022 next year. Let's start off with RCL. RCL has a current production capacity of 17,000 square meters a day. They will expand its Horana facility by adding 3,000 square meters a day in phase 1 by June 2022 at a cost of 1.8 billion. Another 8,000 square meters a day at its Haliagoda factory plant as phase 2 is expected during financial year 24. The Haliagoda plant expansion is planned to use the latest technology where COGS can be reduced by 20% due to various efficiencies. The total capex for this expansion is budgeted at LKR 4.5 billion. The Haliagoda expansion will enable the company to produce extremely large tiles, even as big as 2.5 meters by 1.2 meters. The company projects a payback period of around 3 years on these investments. LWL has a current capacity of 7,222 square meters a day. The company plans on adding 1,500 square meters a day capacity by June 2022 at a cost of LKR 1 billion and another 6,000 square meters a day in financial year 24 as phase 2, if the market for tiles continues to increase. Lanka Tiles has a production capacity of 16,250 square meters at present and plans on adding 1,200 square meters a day by June 2022 at an investment less than 1 billion and another 4,800 square meters a day in financial year 24, dependent on market dynamics. Accounting for the change in operating model, 1Q financials, we have revised down, as a result of the 1Q financials, we have revised down our revenue forecast by 2.3%. But due to the yield management strategies, we have increased our PBT margins in financial year 2022 to 25.3% from 22.3% compared to the 22.6% achieved in the first quarter of financial year 2022. We have marginally revised up the financial year 2022 profit after tax attributable to equity holder forecast by 3.5% to rupees 6.67 billion. But we expect the real growth in earnings to kick in financial year 23 after the expansion of the production facilities and the changes to the product mix. With regards to the RCL valuation, we have revised up our fair value for RCL from 58.2 to 60.2, which is a 55.96 upside from the current price. As explained previously, we have revised financial year 22 earnings forecast marginally, but we have introduced new projections for financial year 23, which will better represent the company's performance in the future. The counter currently trades at a PER of 6.41 times financial year 2022 forecast and 5.7 times financial year 23 forecast, respectively. The fair value is based on a PER of 10 times financial year 2022 forecast, which is in line with the current market PER. Given the earnings growth expected in financial year 2023, due to the expansion and change in product mix, it can be justified for the counter to trade above the broader market PER. But we had ignored that for present. The dividend yield continues to be attractive at 6.24% and 6.93% for financial year 22 and 23. As mentioned before, due to the capex expansion to kick in by June 2022, we forecast a 15.68% growth in revenue in financial year 23 to 52.36 billion, and profits attributable to equity holders to increase by 11.7% in financial year 23 to increase to 7.41 billion. Given the 40% dividend payout ratio, we are forecasting a 6.93% dividend yield based on financial 23 earnings. Moving on to Lanka Volatiles, accounting for the change in the operating model and Q1 financials, we have marginally revised down our revenue forecast by 0.52%. But due to the yield management strategies, we have conservatively increased our PBT margins in FY22 to 17.5% from the 15.5%. This is in line with the 17.1% achieved in the first quarter financial year 2022. Given the higher revenue expected in future quarters, there is a possibility that margins will be even higher in financial year 2022. We have marginally revised up the financial year 2022 PAT attributable to equity holders forecast by 3.2% to 3.05 billion. We expect the real growth again to kick in financial 23 after the expansion of the production facilities and the change in product mix. Moving on to the LWL valuations, we have revised up our fair value of LWL from 99.5 to 102.25, which provides an upside of 46.07% from the current price. As explained previously, we have revised financial year 2022 earnings forecast margin, but have introduced new projections for financial year 2023, which will better represent the company performance going forward. The counter trades at a PER of 6.17 times financial year 2022 forecast and 5.28 times financial year 2023 forecast. The fair value is based on a PER of 9 times financial year 2022 earnings, which is a discount to RCL and the market. Given the earnings growth and expected in financial year 2023 due to the expansion and change in product mix, it can be justified for the counter to trade above the 9 times PER. The dividend yield continues to be very attractive at 6.48% and 7.58% for financial year 22 and 23, respectively. Moving on to the projections. As mentioned before, due to the CapEx expansion to kick in June financial year 23, June 2022, we forecast a 15.17 growth in revenue in financial year 23 to reach 33.95 billion. Profits attributable to equity holders is expected to increase by 16.95% in financial year 2023 to reach 3.62 billion. Given the 40% dividend payout ratio, we are forecasting a very attractive 7.58% dividend yield based on financial 23 earnings. Moving on to TILE's operations, accounting for the change in the operating model and the first quarter financials, we have revised down our revenue forecast conservatively by 4%. TILE's mosaic tile operation is now fully operational, following a few production issues in financial 2021. The mosaic tiles JV is at full capacity, generating approximately 50 million rupees a month in exports. Given the LKR depreciation, the revenue and margins of this operation is expected to increase significantly. Looking at the PBT margins, TILE has the highest PBT margin across the group companies at present, amounting to 28.6%. We have conservatively increased our PBT margins in financial year 2022 to 28.9% from our previous forecast of 22.1%. This is conservative, considering the company achieved a PBT margin of 28.6% in the first quarter of financial year 2022, which is usually the worst performing quarter. Given the higher revenues expected in future quarters, there's a possibility that margins will be much higher than forecasted. We have revised up our PAT attributable to equity holders by 13.1% in financial year 2022 to 2.77 billion. We expect the real growth again to kick in financial 23 after the expansion of production facilities and product mix changes. Moving on to the TILE valuations, we have revised up the fair value of TILE from 79 rupees to 94.1 rupees due to this change in margins and change in profitability. This is an upside of 52.27%. As explained previously, we have revised up financial year 2022 earnings forecast. We have introduced new projections for 2023 as well, which will better represent the company's performance going forward. The counter currently trades at a PER of 5.91 times financial year 2022 earnings and 5.1 times financial year 23 earnings. The fair value is again based similar to our LWL at 9 times financial year 2022 forecast earnings. Given the earnings growth expected, again there's a reason to assume that the market multiples should be higher than 9 times for the counter. The dividend yield continues to be very attractive at 6.77% and 7.84% for financial year 22 and financial year 23. Moving on to the TILE projections. As mentioned before, we have assumed a capacity addition of 1,200 square meters to kick in by June 2022. We forecast that to result in a 19.59% growth in revenue in financial year 23 to 14.06 billion rupees. The profits attributable to equity holders is expected to increase by 15.95% in financial year 23 to reach 3.21 billion. Given the 40% dividend payout ratio, we are forecasting a very attractive 7.84% dividend yield based on financial year 23 earnings. Moving on to SWISSTEK CEYLON. SWISSTEK is expected to continue achieving top-line growth by strengthening its distribution network. This will be done through the utilization of our sales distribution network in financial year 22 and 23 for the flooring segment, which is expected to increase in motor sales. The aluminium sector revenue is also expected to increase due to the price increases passed on to customers in July 2021 due to high global aluminium prices. With the availability of capacity, the company expects higher capacity utilization during financial year 22 and 23. The company is also expected to win more large-scale project contracts due to its partnership with ITEM to supply aluminium products to leading large-scale projects. The whole aluminium industry experienced contractions in margins in the first quarter financial year 2022 due to high aluminium prices in the global market. The margins are expected to increase in future quarters, though, after the price increase implemented in July. Management is in the process of protecting margins despite the high global aluminium prices by increased use of scrap aluminium sourced locally. The management expects to increase the use of locally sourced scrap aluminium to over 35% of the total aluminium billet requirements. The company is also in the process of moving ahead with its product diversification strategy by increasing the contribution of value-added aluminium products such as ladders, pantry cupboards, etc. The demand for mortar sales and adhesives is also expected to increase as RCL, LWL, and tile increases the production of the larger tiles that requires the same. As you can see, the price of global aluminium prices have increased by 51.9% in USD terms over the last 12 months. The increase in LKR is even more given the depreciation of the LKR. By sourcing more scrap aluminium locally, the impact of high global aluminium prices can be mitigated to some extent. Due to the challenging first quarter, SWISSTEK revenue and margins were below our forecasts. Due to the above, revenue forecasts were reduced by 10.4% compared to our previous forecast. Due to the impact of aluminium prices and depreciation of the LKR, we have revised down PBT margins for financial year 2022 to 12.5% from 12.6%. We have forecasted higher margins in Q2 to Q4, given the price increases implemented in July 2021. We have revised down the PAT attributable to equity holders by 8.4% in financial year 2022 to 595 million. But we expect the company's performance to bounce back in financial year 23 to post a 660 million profit. Moving on to the SWISSTEK valuations, due to the challenging environment experienced by the industry in the first quarter, we have revised down our revenue and earnings estimates for SWISSTEK. The downward revision of our forecast for financial year 2022 is based on the expected margin contraction within the aluminium segment. Accordingly, SWISSTEK is currently trading at an earnings multiple of 6.3 times financial year 2022 forecasted earnings and 5.68 times FY23 forecasted earnings. We estimate SWISSTEK's fair value at 34.8%, providing a 27.01% upside at a PER of 8 times financial year 2022 forecasted earnings. We forecast an EPS of 4.35 rupees per share in financial year 2022. We expect the counter to recover in financial year 23 owing to stronger operational growth. The dividend yield for financial 2022 and financial year 2023 is forecasted at an attractive 6.35% and 7.04% based on a 40% dividend payout ratio. As mentioned before, the increase in raw material prices, the PAT attributable to equity holders is expected to remain flat in financial year 2022 compared to 2021 at around 596 million rupees. We forecast a 10.8% growth in profit attributable to equity holders in financial year 2023 to reach 660 million. The dividend yield for financial 2022, as stated earlier, is 6.35%. as mentioned before, due to the capacity expansions, with the capacity expansions expected to kick in June 2022 for RCL, LWL, and TILE, we forecast the financial year 2023 PRs to be extremely low for the TILE-related counters. But interesting to note, TILE is currently trading at the lowest PR of 5.1 times for forecasted earnings in financial year 2023, followed by LWL at 5.28 times, then SWISSTEK at 5.68 times, and RCL at 5.77 times. Given the extremely low PRs in financial year 2023, it is justified that the counters should be trading at higher multiples in financial 2022. But we have been conservative in maintaining our previously stated PR multiples for the financial 2022 fair valuations. Once management initiates the expansion plans in the future, we will reevaluate our valuation methodology assumptions. That is it on the tile sector, and we will take your questions on the same after Divya finishes her presentation on the fabric sector.
Thanks, Hasita, for your insights on the tile counters. Moving on to the textile industry, let's have a look at the global textile market. The market is expected to grow at 10.1% year on year, from $594.61 billion in 2020 to $654.57 billion in 2021, with the revival in the economies. It is expected to grow at 6% CAGR to touch $827.87 billion in 2025. Sri Lanka's total apparel exports grew 26.71% year on year to $2.32 billion in Jan to June 2021. The growth was primarily led by EU market, which grew 39.71%, and US market, which grew 11.7%. In the first half of 2021, apparel exports to the EU accounted for 45.2% and US accounted for 39.9%. Following the pandemic, retailers are focused on moving away from single destination sourcing. Also, the US-China trade war and the Xinjiang cotton ban has resulted in a major shift, with retailers preferring alternate manufacturing centers such as Sri Lanka, India, Bangladesh, Africa, and Dominican Republic, which will positively drive the fabric manufacturers' volumes going forward. Further, in the unlikely event of a GSP Plus removal, the local fabric manufacturers will have no impact owing to the supply chain relocation strategies previously discussed. The larger fabric mills, TJL and MGT, are well positioned to capture the opportunities arising from the demand and supply gap in the synthetics market. The local apparel industry imports approximately $630 million of synthetic textiles annually versus a domestic production of $50 million. Given the factors discussed, along with the increasing demand from buyers, industry consolidation is witnessed. The local fabric manufacturers are further strengthening their position through inorganic growth via acquisitions and capacity enhancements. Moving on to raw material prices, looking at the graphs, it is evident that cotton prices have seen a sharp upward trend since December 2020. Cotton prices increased 30.3% year on year on average during Jan to June 2021. Cotton prices in the first quarter grew 40.1% year on year to $2.08 per pound from a low of $1.40 per pound in April 2020. After stagnating during the early part of the pandemic, the textile industry has begun to strongly recover and the demand for cotton has risen. It is expected that consumption will grow faster than supply, leading to a reduction in global cotton stocks and higher prices. Further, given the restrictions in sourcing cotton from China, India will be the main producer, and Indian cotton prices have increased along with the increased demand. The industry players are anticipating a price correction end of the year, considering the new crop, which is to be released in October, November. However, prices are expected to remain elevated. Synthetic prices generally move with oil prices, as synthetic fibers are made from petroleum polymers. Crude oil grew significantly by 121.3% year-on-year to 71.8 cents per barrel in first quarter financial year 22. Prices during Jan to June grew at 59.2% year-on-year. Prices are expected to remain at these levels through 2021, with a possible decline in financial year 22, considering supply growth outpacing decelerating growth in global oil consumption. As per industry players, the cotton prices moved sharply over the first quarter compared to the increase of the synthetic prices. Now that we have discussed the recent trends in the industry, we can take a closer look at how the specific companies have performed in the first quarter and their future outlook. Let's have a look at MGT's performance. Post-acquisition of South Asia Textiles in April 2021, MGT Group added an additional capacity of 25 tons per day, taking the group's total capacity to 55 tons per day. The group has been very successful in effectively using additional capacity by taking on orders from their buyers and subcontracting to SAT. This has driven revenue growth at a group level by 94.89% year-on-year and 56.33% quarter-on-quarter. A revenue of 5.81 billion was recorded for the first quarter of financial year 22. As per management, both facilities were running at full capacity. MGT catered to synthetic products for Tier 1 brands, including Nike, Victoria's Secret, Intermissimi, and Decathlon during the quarter, while SAT, which originally operated as a cotton-based fabric mill, catered primarily to cotton-based business from MGT. MGT company on a standalone basis also has recorded strong revenue growth of 39%, with revenue at 4.15 billion rupees. Gross profit was recorded at 830.35 million rupees, with gross profit margins at group level strong at 14.28%. The gross profit margins has improved from the fourth quarter, which was recorded at 13.28%, although lower than previous year at 14.89%. The decline was as a result of the increasing cotton prices and polyester yarn prices. However, gross profit margins improved on a quarter-on-quarter basis, led by strong top-line growth dominated by synthetics. The improvement of gross profit margins is also owing to the effective management and procurement of raw materials. As mentioned before, polyester prices increased at a slower pace than cotton yarn in the quarter. The company uses a mix of ring-spun polyester and other types, including recycled polyester, which benefited margins. MGT generally books 75% of the yarn prices 6 months in advance, thereby only keeping 25% open to fluctuations, enabling them to better manage raw material price fluctuations to a great extent. Operating profit was recorded at 339.44 million rupees, a 86.53% growth year-on-year and 141.38% growth quarter-on-quarter. Notably, SAT recorded a strong turnaround in performance, recording an EBIT margin of 7.51% in the first quarter versus 0.04% in financial year 21. As a result, group EBIT margin improved by 206 basis points to 5.84%. SAT currently functions with a lower cost base, and some key functions including finance, marketing, and supply chain are handled at a group level. Borrowings increased from 3.32 billion in the fourth quarter to 8.73 billion in the first quarter of financial year 22 as a result of the USD $10.5 million loan undertaken for the acquisition and other working capital facilities. Net finance costs recorded 36.23 million rupees in the first quarter, including exchange gains led by the currency depreciation. The company has obtained long-term loans in rupees, given the low interest rate and view of a further depreciation of the currency. Thereby, the group has effectively managed their interest cost. Net profit attributable to equity holders was recorded at 298.81 million rupees, a growth of 187.7% year-on-year and 79.67% quarter-on-quarter. SAT has recorded a strong turnaround in performance. MGT company earnings also witnessed strong growth of 76.1%. Plans are underway for a complete transition to a world-class manufacturing plant, similar to MGT's main manufacturing facility. The group expects to expand capacity at SAT by 15% in the first quarter of financial year 23, with an investment of $8 million, where technology and machinery will be upgraded. At present, SAT capacity is being filled by MGT, obtaining orders and onwards outsourcing to SAT. With the upgrade, SAT will be able to take on more direct orders from Tier 1 brands and move towards product mix similar to what is handled at MGT, which is primarily dominated by synthetic products. MGT is expected to aggressively focus on US brands including Nike, Victoria's Secret, VS Pink, Tommy Hilfiger and Calvin Klein, and EU brands Intimissimi and Decathlon. Nike, along with other retailers, are benefiting from the rebound in consumer spending and the return of pandemic-hit sports events. Growing demand for athleisure products and in turn synthetics should result in strong revenue and margins going forward. Considering the first quarter performance and the fast-paced turnaround of SAT, which generated profits within the first month of acquisition, we have revised up the earnings forecast for MGT for financial year 22 and 23. Revenue has been revised up by 2.72% from 26.4 billion to 27.15 billion in financial year 22, considering the ability of MGT Group to immediately fill capacity across both manufacturing outfits from increased demand from Tier 1 buyers and the expected LKR depreciation. The order book is full over the next 2 quarters, with both manufacturing facilities expected to be operated at full capacity. Further, we expect an increase in the average prices in the second half of financial year 22. In financial year 23, revenue has been revised up by 7.65% from 29.7 billion rupees to 31.98 billion rupees, considering the increased capacity of 15% coming into the SAT facility, the LKR depreciation and the expected increase in ASP in third quarter financial year 23. The investment will upgrade machinery and technology to bring the facility on par with MGT, enabling them to obtain direct orders from Tier 1 brands. The forecast has been updated to reflect a 12.5% year-on-year average rupee depreciation, with exchange rate at 230 rupees as at end of financial year 22, and 10.34% year-on-year average depreciation, with exchange at 241 rupees and 50 cents in financial year 23. This also boosts group revenue further. We expect financial year 22 gross profit margins to average at 14.54%, considering an increase in the average selling price. In financial year 23, gross profit margins is expected to increase by 58 basis points year-on-year to 15.12%. We believe that these margins are sustainable, given the effective cost management strategies adopted. Further, as the price contracts are fixed for a period of 6 months, the company books 75% of raw materials 6 months in advance, enabling them to manage margin fluctuations to a greater extent. We have assumed that the group administration and selling and distribution costs will be in line with the first quarter level. EBIT is expected to grow 120.54% year-on-year to 1.96 billion and 38.8% year-on-year to 2.73 billion in financial year 22 and 23 respectively. EBIT margins are expected to be at 7.23% and 8.52% in financial year 22 and financial year 23 respectively, compared to the 5.53% in financial year 22 and 6.1% in financial year 23, which we forecasted previously. The group has benefited from the low cost base of SAT and centralization of key functions across both manufacturing outfits. Thereby, net earnings forecast for financial year 22 increases from 890 million rupees to 1.54 billion rupees, which is a year-on-year increase of 109.5%. In financial year 23, net earnings forecast has been revised up from 1.22 billion rupees to 2.02 billion rupees, resulting in a 31.34% growth over the previous year. We believe that these forecasts are conservative, as we have not accounted for the tax savings that could arise from the accelerated depreciation on the $8 million capex and possible understating of the rupee depreciation on the net finance expense. Moving on to the valuations, MGT is currently undervalued, trading at 6.6 times FY23 earnings. Our valuation methodology remains unchanged from the previous webinar and research report, and we continue to assign a fair value-based price to earnings ratio of 9 times on financial year 23 forecasted earnings. This results in a fair value of 43 rupees and 90 cents, providing an upside of 36.34%. The PER valuation multiple has been arrived at considering the market price to earnings ratio and the comparable export-oriented company price to earning ratios. The financial year 23 earnings have been considered when arriving at the fair value, as we believe financial year 22 will be a year of transition, as the company will be restructuring the operations of MGT and SAT, and further machinery upgrades and capex will materialize in financial year 23. As mentioned before, 109.5% year-on-year growth in earnings is expected in financial year 22, and 31.34% growth is expected in financial year 23. As a result of strong earnings expectation, as well as 100% of the company's revenue being in foreign currency, providing investors a natural hedge to rupee depreciation, we expect increased investor appetite towards this counter. We expect a dividend payout of 40%, resulting in a 4.61% dividend yield during financial year 22 and an attractive 6.06% yield in financial year 23. Moving on to TJ Lanka. Let's have a quick look at how they performed in the first quarter of financial year 22. The group recorded its highest ever quarterly revenue since inception at 10.38 billion rupees. This was 119.4% growth over the previous year and a 6.3% growth quarter on quarter. Despite the revenue growth, margins have come under pressure with the increase in cotton prices, with GP margins recorded at 7.41% compared to 11.77% in the fourth quarter, although this was higher than the 5.41% recorded in the first quarter of the previous year. In addition to increase in raw material prices, the margins were also impacted as the company outsourced orders. At present, approximately 10% of orders are outsourced. This strategy has been adopted primarily to gear up for the capacity expansion by booking in large volume orders. Accordingly, once the capacity is available, a portion of this will be catered to in-house, although outsourcing may continue depending on the additional demand even after expansion. Outsourcing was also adopted as a risk mitigation strategy, providing the group an alternate location while minimizing impact to buyers from the pandemic-related issues that could be faced at their own manufacturing outfits. Margins were also impacted as the yarn price increase materialized early in the quarter, while a time lag is experienced with the sales price increase commencing only from the latter part of the quarter. A phased approach is generally adopted when passing on higher costs to key strategic buyers. Operating profit margins, although higher than the corresponding period of last year, declined to 3.3% compared to 7.99% in the fourth quarter. Net profit after tax attributable to equity holders was recorded at 310.5 million rupees compared to the loss of 31.5 million rupees recorded in the first quarter of the previous year. Strong revenue growth was experienced with all 8 strategic brands performing better than the previous year. PVH was the #1 customer, contributing approximately 37% of the sales. The growth was primarily driven by onboarding of new programs. Increased volumes from Nike, L Brands, and Uniqlo was also witnessed, with Nike volumes expecting to double over the year, moving into new product segments, including synthetics. Uniqlo was also growing well, with new products expected to come into the order book over the next few quarters. Old Navy is the latest addition into its key strategic brand portfolio. The company is on track with the capacity enhancement of 25%, primarily in the Indian facility, which will add approximately 20 tons per day, taking the group's total capacity close to 95 tons per day. The total investment of $26 million will be mainly funded through equity given their strong cash balances. The new capacity additions made by the company consists of dual-capable machinery, which provides the flexibility to produce both cotton and nylon products. This will enable the company to cater to the demand-supply mismatch in the synthetic fabric requirement. Moving on to our forecasts, we have revised our forecast upward on top line from 42.2 billion rupees to 49.69 billion rupees, reflecting a 56% growth in revenue year on year. We have assumed that the growth will primarily stem from volume growth across key strategic brands, further supported by the currency depreciation. 20% of the capacity enhancements is expected to come into effect in the fourth quarter of financial year 22, with the balance in early financial year 23. The company has already started outsourcing some of the orders owing to the increased demand from the strategic accounts. Considering the enhanced capacities, the group is expected to record revenue of 61.39 billion rupees in financial year 23, a growth of 23.55% year on year. This was an upward revision from 48.76 billion rupees. The revised exchange rate assumptions, which expects the rupee to depreciate to 230 by end of financial year 22 and 241.50 by end of financial year 23, also contributes to the upward revision in the forecast. Gross profit margins are expected to continue to be under pressure, given the increasing raw material prices. We have revised down our assumptions used for gross margins, given the increase in cotton prices witnessed in the first quarter, and the margins also recorded in the first quarter. GPMs are expected to improve over the next few quarters, with margins expected to be at higher single-digit levels of about 9.8% in financial year 22 and touch 10.5% in financial year 23. The company does not see the prices significantly coming off, although prices may ease with the new cotton crop expected in October-November. Over the next quarters, the group will increase prices to customers on new programs, which should also positively impact the margins. Operating profit is lower than we previously forecasted at 3.21 billion, given the decline in margins. However, remains a year-on-year growth of 29.14%. For financial year 23, considering the capacity enhancement and revised exchange rate depreciation assumptions, operating profit is revised up from 4.28 billion rupees to 4.62 billion rupees. Operating margins are expected to be lower than in the past at 6.46% and 7.53% in financial year 22 and 23 respectively. Significant top-line growth is expected to somewhat mitigate the adverse impact arising from pressure on gross margins. While an upward revision of forecasted revenues has been done, considering the factors previously discussed, earnings forecast for financial year 22 has been revised down by 6% to 2.62 billion rupees, factoring the decline in margin. Earnings for financial year 23 is forecasted 10.14% higher than the previous forecast at 3.67 billion rupees. The profit after tax attributable to equity holders is expected to grow by 22.36% to 2.62 billion rupees in financial year 22 and 40.35% year on year to 3.67 billion in financial year 23, led by strong revenue growth. The capacity increase to support the key strategic brands Nike and Uniqlo in financial year 22 and 23, and the growth in some of the larger Indian domestic brands, along with the average selling price increases to support the higher raw material costs, are expected to be the key pillars of growth. TJL is currently undervalued, trading at 8.41 times FY23 earnings. Our valuation methodology remains unchanged from the previous webinar and research report, and we value the company in line with the broader market PER of 9.96 times FY23 estimated earnings, which derives a fair value of 51 rupees, providing an upside of 18.33%. The company trades at a premium to its local peer MGT. This premium is justified given the sheer size of the facility, its regional footprint, and higher liquidity levels on the counter. In line with our previous update, financial year 23 earnings have been considered when arriving at the fair value. As we believe financial year 22 will be a year of transition, as the company will be enhancing their capacity by 25%, which should fully materialize in the first quarter of financial year 23. We expect a dividend payout of 76.54% in line with 2 years historic average payout, which results in a 6.48% dividend yield during financial year 22 and an attractive 9.1% in financial year 23. That is it from our end. Thank you. Over to you, Prashani, for the Q&A.
We thank you, Hasita, Divya, and the analyst for the valuable insight on the Colombo stock market. Now, can Mr. Shehan Mendes of Capital Trust Securities moderate the question and answer session, please?
Good morning, ladies and gentlemen. Thank you for participating for this important webinar that we are having today. And Sita, Divya, thank you very much for your insightful presentations once again. You must be wondering, we had to send a new invitation to you all, and we were hoping to cover a few more counters as well in this presentation. Unfortunately, the content we had to share with you all 2 hours is definitely not enough to cover those companies, and it's not right for the sake of covering just to rush through these companies. It's important that you all have, as investors, that you all have a good understanding about each and every company that you all buy. So we thought of breaking the presentation into 2 parts. This presentation will be covering the tile sector and the fabric sector, and very much anticipated the next week presentation will be covering some of the other counters that you all are very much eager to know about. I'm sure, even though early on you all would have been disappointed to see the split in the presentations, I can assure you, you all won't be disappointed when you all come for the next presentation next week. So having said that, now I would like to open the floor for the Q&A session. Please, we would love to clarify any questions that you all may have from Divya and Hasita. So I have already got some questions. I'll start off with Hasita with some of the tile sector questions also. Now, one of the concerns that investors would be having is, Hasita, now we know last year the tile sector companies were able to sell off some of the excess stocks that that have got accumulated over the years, and now that they've been running at full capacity, plus they've been selling all these excess stocks, and given that the imports are banned at the moment, do you see could there be a possibility of a price revision now that they don't have any excess stocks to provide? And on the other hand, the dollar also have appreciated, so it probably creates some space for them to, if they want to increase prices. Do you anticipate any price revisions in the tile sector?
So yeah, like what you said, obviously last year, because since 2018-19, the demand for tiles reduced. But obviously that created an excess capacity at each production facility for the three companies. That resulted in built up capacity to a certain extent, built up inventory, I mean. But then last year with the lockdowns, as well as 10 weeks after the lockdown, production was stopped at the facilities, right? So as a result, the company drew down on that excess inventory. But now, as I mentioned before, the built-up inventory is at times less than 1 month. So, with your the answer to your question in terms of price revisions, so there's a change in the product mix, as I mentioned before. So I think there is talk of price controls on certain smaller tiles because various agents and dealers have been increasing prices, whereas the companies themselves, the prices they've been supplying to various dealers and agents haven't changed. So what the company said, the stance the company maintains is on the smaller tiles, they're going to continue the same pricing. There's not going to be a price revision. They're managing cost escalations through various efficiencies brought into the production process, as well as the procurement, etc. Right? But what's happening is there's going to be since they're moving on to the larger tiles, which are 1 meter by 1,200 millimeters by 600 millimeters or 1,000 millimeters by 600. Those larger tiles, the prices are much higher than the smaller tiles, obviously, per square meter, if you look at it, right? So by focusing on that, they will have higher margins going forward. So you can already see that for the tile companies, especially if you look at tiles, the listed company tiles, their PBT margins have increased considerably, even quarter on quarter, because of the change in mix. So that's what's happening at the moment. They're not going to increase prices of the small tiles. So that's why we don't even foresee an impact of price controls on the company, because they have not increased those prices for the last 4 years, and they don't intend to increase it going forward.
Understood. Thanks, Hassan. So is it safe to say that now their plan is to basically improve the product mix? And is it safe to say that there is a growing trend in the buying, in the demand patterns also to move into these large tiles compared to the previous generations who have bought tiles? Is there a change in the demand patterns also?
Yeah, so for the last few years, there has been a change. The demand has been increasing for the larger tiles. So even for SWISSTEK, I think what we've stated in our previous research reports, the initiations and updates, their grout sales, grout is usually used for small tiles, whereas mortar and adhesives are used for large tiles. So even for SWISSTEK, that's the growing segment. So this is a trend that has been happening for the last so many years or quarters, and this will continue going forward. That's why even the expansion plan, they're looking at technology that will do even larger tiles. So they see that as a growing market with higher margins, whereas the smaller tiles they're expecting to phase out to a certain extent, not completely stop it. And that segment will be catered to by MAC tiles going forward.
Right. Moving on to you, Divya, one of the key points that intrigued me was in your presentation about the mentioning about the expectation about the exchange rates for FY22. The expectation was about 231, and FY23 was about 240. Correct me if I'm wrong. I think those were the expectations. So, are you, from macroeconomic point of view, do you expect these exchange rates to depreciate to those levels at the end of those financial years?
Yes, Shahan, that is actually our in-house view at the moment. If you look at even at present, there are some importers and various clients who have sort of opened LCs at about 215, between 215 to 220 levels. So, I mean, that seems to be where the market is heading. So we feel that by next March, realistically, the currency should be around 230 rupees. And from there on, we have expected another about a 10% depreciation thereafter as well for the following year.
Okay, so probably a follow-up question on that would be, now we know that these fabric companies are exposed to foreign exchange risks in both ways, imports as well as on their exports. Now, in rupee terms, however, how would the impact would be on their GP margins and NP margins? What is your thoughts on that?
So the fabric manufacturers, I mean, essentially, most of their turnover actually is foreign currency denominated, primarily dollars. And roughly, if you look at maybe input costs, about 70 to 74% maybe raw materials might be imported. But saying that, because bulk of their receivables are in foreign currency, while only 70 to 74% is what's required for importation purposes, they can pretty much well manage, and actually they will be a beneficiary in an environment like this.
Shahan, just adding to what Divya said, when you have to look at NP margins for MGT, for example, how they're funding their expansion in terms of acquisition as well as the capacity enhancements, they're taking rupee denominated loans at around AWPLR, right? So in a currency depreciating environment, there are going to be foreign exchange gains. So if you look at the fourth quarter performance of last financial year, when the rupee depreciated around 6%, if I'm not mistaken, their net finance cost was actually positive. So even this quarter, with the rupee depreciating to a certain extent, the finance costs should reduce considerably when we account for the exchange gains. But in our projections, we've been very conservative and we are not accounted for those exchange gains on the interest costs. So our interest costs in a depreciating environment is overstated. If we account for that, the profitability of the company will be much higher. So there's a big impact of the rupee depreciation on an NP level as well.
Okay, thank you, Divya, Hasita. There's a question from Takya Hingurankala. The question is, what are the imported raw materials used in tile and ceramic manufacturing? What is the forecast on uninterrupted supply of those materials? Hasita, I think you can take that question.
Yeah, so basically, the two items that they import, that they import is LPG, obviously. So there is an uninterrupted supply coming in. And for bulk supply of LPG, there is no price controls, right? Like the domestic LPG supplies. So the company has been exposed to higher costs of around 40% since December. The other item that they import is packing materials. Again, there has been about a 50% price increase on that front. So those two are the main items that they import. And in packing material, they have stocked up, they have quite a bit of inventory. So even if there are delays in freight, for example, which is experienced globally, they have sufficient supplies for the time being, and supply interruption shouldn't be a big issue.
Okay, right, understood. There's a question from LJ. I believe this must be with regards to the fabric companies, how macroeconomics parameters are going to impact to the industry, examples, inflation and buying power of consumers, etc. This can be taken actually for both tile and fabric companies also, both.
So I can start off with the tile, the impact, right? So on the macroeconomic perspective, the demand for tiles is currently driven by residential construction. It's not project linked. Currently with the low housing, the interest on housing loans, that's really driving demand for house renovations and house builds. So at the same time with inflation, when inflation comes in play, what happens is there is a greater buying pressures, right? So that should actually result in greater buying. So at the moment, what we're seeing is, yes, demand is increasing. That's why we're expecting the sales to increase this year compared to last year. That will continue going forward. So we don't see the macroeconomic climate really impacting demand side. And anyways, there's a demand supply mismatch at the moment, as I mentioned before, in financial year 2022. That should be offset by the increase in production capacities next year. That will enable the companies to maintain a balance and make the country self-sufficient in terms of tile production.
So, I mean, moving on to the fabric sector. So most of these, actually MGT and TJL primarily export, bulk of, or they're indirect exporters. So if you look at it, it's actually the other markets, the macroeconomics that's going on in the other markets that's largely impacting them. So, I mean, sort of given the pandemic, most of the, say, US and EU now at the moment, they are possibly reviving. And even IMF has actually upped their forecast expectation on GDP growth in the US as well as EU. So we expect economic activity to pick up. So along with that, you expect unemployment to go down and consumer spending power also to increase. So most of the end buyers and the retailers should have good sales volumes this year. So that should positively impact the fabric manufacturers. Also, other than that, from a local perspective, if you look at just synthetics alone, right, the requirement locally, say, is around $600 million, and we only produce about $50 million. So even if you look at like the local apparel exporters requirement, we don't even fulfill that need. So the fabric manufacturers are in a very strong position at the moment to even benefit from this demand supply mismatch and the requirement. So we feel that the fabric manufacturers, I mean, all sort of indicators point towards them having a very good 2 years going forward.
Okay. There's also a question, an interesting question on the port city. This is from Marlon Shreve. He's asking, how will the tile sector benefit from the port city? There was another question also in the same lines, which came to me. As in, can the companies that are going to be incorporated inside the port city, can they directly import, or are these tile companies are going to basically provide tiles for these companies as well for their construction?
Okay, just answering that question. Okay, the requirement for tiles from the port city will be 3 years down the line. So when that happens, we'll have to see whether there's an import ban in place or not. But regardless of port city, for example, at the moment, there's a demand supply mismatch. Even if there is a requirement, the company can't really fulfill it. Even going forward next year, there are so many other projects that are that the company is looking to cater to other than the residential market. So even with the capacity enhancement, we expect them to run at full capacity. If there's a requirement as large scale as port city, at the moment, I don't think they'll be able to fulfill it because of capacity constraints.
Okay. There's a question on SWISSTEK. Divya, you wanted to add something, or?
No, Shahan, I think Hasta covered most of it.
Right. Okay, thanks. But there's a question from, yeah, sorry, I can't see the name, but I'll go ahead with the question. In terms of SWISSTEK, does the capex expansion solely focus on tile-related products or both grout and tile products? I think we lost.
Sorry, I'm back on. I think I lost my. There was a dropping connection. Sorry.
Right. So I'll repeat the question for you.
Yeah.
From Deshan Hettivatta. In terms of SWISSTEK, does the capex expansion solely focus on tile-related products or both grout and tile products?
So SWISSTEK, actually, there is no capacity expansion plan between, especially in the aluminium facility. There is actually excess capacity. So if you look at the whole sector, there is a bit of excess capacity. So there is no capex requirement there. And previously on the more at the flooring space, they previously went for capex. So there is no planned capex for SWISSTEK at the moment. The planned capex is for the 3 tile companies.
Okay, and there's actually a concern from my end also that I would, if you can take up, Husker. Basically now SWISSTEK, one of the key challenges they have at the moment is the increasing aluminium prices in the global market, and also the rupee depreciation. Now the only alternative that they have to source scrap aluminium from the locals, because that is not allowed to export. So what type of in the purchasing, what type of a mix are these SWISSTEK is having in terms of the imported raw materials versus scrap aluminium sourced locally?
Previously, like in last financial year, the target was around sourcing 30% of scrap aluminium locally. And I think this year they're looking to increase that even to 35 to 40%. So that's their way of eliminating the increase in aluminium prices to a certain extent.
Okay. There's also another question on this is from Malidu Rajapaksa. This is, I think he's asking about more about the price movement. His RCL price is still moving around 38 for a long time. Is there a particular reason why it has got stagnated around that price?
So I think, again, as I listed in the presentation earlier, I think there's a lot of misconception associated with the tile sector in terms of the risk associated with it. From the quarter-on-quarter earnings drop. I think that was a big concern for quite a few investors. Then the other is, okay, what happens if the import ban is lifted? So I think there's quite a bit of misconception there. But I think, as I addressed it, those aren't really risks that we should be worried about. First of all, import ban, given the rupee depreciation, given the increase in freight costs, given the increase in cess, that stops under-invoicing, as well as it makes imports quite uncompetitive compared to locally manufactured goods. So I think even the management of these 3 tile companies have enough confidence now to go ahead with the expansion plans. Previously, they held fire going for expansion plans because they were wary of import substitution, for example. So that increase in cess gave them the confidence, okay, now they can go with the expansion plan and see good returns on that investment.
Okay, right. Divya, we know that MGT acquired SAT recently, and there was for the purchase, MGT had to pay quite a sum of money, and that is, we know that that's going to basically increase their finance costs going forward. But inclusion of South Asia textiles, what type of a value addition can they do to MGT versus the finance cost that will be coming into their P&L moving forward?
So Shahan, yes, the acquisition, finance cost will go up, but I think, like Hasita mentioned previously, in a rupee depreciating environment, the company has actually obtained loans in rupees and at very very, very good rates. And actually there, even though finance cost on the loan itself will rise because of the rupee depreciation, the net impact would not be significant. Yeah. Also, in terms of the acquisition alone, right, their capacity has increased by over 83%. And given MGT's strong relationships with their buyers, even in the first month after taking over the operation, SAT has already become profitable. And within the first quarter, when you look at the results, the turnaround is evident, and the the significant growth that is going to come about through this capacity enhancement is very evident even in the numbers. So we are actually very confident that the company would be able to completely fill both plants' capacity, and also, you pretty much leveraging off their existing relationships with their buyers, as well as, they have capacity expansion plans even for the next year to bring SAT facility on par with MGT. Because at the moment, even though the facilities are full, SAT primarily caters to, the cotton product mix, because that is what they were doing previously as well. So over a period of time, they will upgrade the machinery and technology and make the necessary amendments. And they will also start being able to cater to that similar product mix as MGT on a standalone basis. So, taking all these into consideration, we think the benefits associated with the acquisitions far outweighs the finance cost.
Okay. There's another question from Radish Sellamuth. The question is, any insights on the chocolate and biscuit factory under RCL, size of investment and potential turnover, and in which year this will kick in?
So that's an interesting question. So we've actually, what we've been told by management is RCL actually doesn't have any plans of investing in this chocolate factory. So they have the land, which they will actually lease out to another company to carry out this whole chocolate factory. So that won't come under RCL. So I think that's a popular question amongst quite a few investors. But the chocolate factory or biscuit factory won't be under RCL going forward. It's just that they'll be leasing the land.
Okay, thank you, Hasita. Also, there is another question from Shakityan. There is a trend going on for shifting towards wood flooring and vinyl flooring for luxury projects. Even though Delmage is part of Haley's group, is the sole player in the sector, won't it affect the tile sector?
So actually, SWISSTEK is quite is one of the leading players in that whole wood flooring segment. But if you do a cost comparison of wood floorings against tiles, there's a big difference. So I think the market is quite big enough where there will be a few really high-end apartment projects or luxury commercial developments that will go for this wood finish, and SWISSTEK will benefit from that. And I think SWISSTEK has around a 50% GP margin on this wood flooring segments. So even for Jonki's project Waterfront, they were the suppliers, and that was considerable in terms of the profit contribution. So if there is a shift towards that for larger projects, it'll be more beneficial for the SWISSTEK and RCL group companies because they'll be generating higher profit margins on that product.
Right. There's another question from Vasant Sithambarantan on the tile sector. Out of the three counters, which counter is exposed to a higher percentage of imported raw materials? Is there any idea, Hasita, any light that you can shed on this?
So it all depends on production capacity, right? In terms of the usage, it will be all proportional. So as I said, in terms of capacities, RCL has the highest capacity at around 17,000, if I'm not mistaken. Then tile has around 16,250, if I'm not mistaken. And then LWL had around 1,222. So it'll be all proportionate because it's more or less the same production process. There is no real difference in terms of one being exposed to the other. It's just all proportionate.
Right. There's another question from, unfortunately, I cannot properly see the name. I'll ask the question. What would be the effect on MG TGL in the event of Sri Lankan government ISB payment default? It's an interesting question.
So actually, in the unlikely event of a default, if that does occur, then rupee should depreciate significantly. You're looking at like a significant depreciation. So in the event of a significant depreciation, when your entire earnings are actually in foreign currency, your performance will just, you record extremely strong performance. Because as is, just us incorporating our expectation on 230 rupees for next year and 241 rupees for the year after gives them, such like a strong performance and strong earnings. In the unlikely event that a default does happen, the rupee will significantly depreciate and their earnings and performance will just shoot up.
Okay. There's another question on, I cannot properly see the name, but I'll ask the question. I see a lot of potential in Alumex too. They are too into capacity enhancement by 100%.
So I think Alumex increased their capacity by 100% a few years ago. So until last year, or until the import ban was in place, there was quite a bit of excess capacity because SWISSTEK and Alumex both went for 100% capacity increases. But then after 2018-19, the demand for construction materials came down by about 25%. So that really affected them. But yes, Alumex is the market leader in the aluminium segment, and they are larger than SWISSTEK. But in terms of performance, if you look at it, so I think last quarter, SWISSTEK's bottom line was higher, if I'm not mistaken, than Alumex, because the aluminium segment didn't do too well with the increasing global aluminium prices. But SWISSTEK had a very good contribution from the flooring segment. So that offset the decrease in profits. So yes, Alumex will do much better from this quarter onwards with the price increase, but so will SWISSTEK.
Okay. There's a question from Deshal Hemachandra. Can you please explain how, in the unlikely event of the loss of GSP Plus, can be curtailed by sourcing changes? My understanding is that if GSP Plus is lost, it would negatively affect the revenue side of things. I think we touched upon this question on one of our previous webinars when we covered both TGL and Haley's MGT separately. But we can probably, for the benefit of everyone, we can take that question up again.
Sure. So in terms of, to start with, even if you look at exports to the EU, not all of it qualify for GSP Plus, right? So, if you look at some of the fabric manufacturers, when they do indirect exports, maybe out of the 60% that goes into EU, maybe only about 5 to 7% may even qualify, right? So given that alone, we expect the impact to be minimal. But saying that, like we mentioned before, the demand for fabric is so high, even say locally, where there's a massive demand-supply mismatch. If you look at what even apparel exporters need, and our local mills are still not producing. So even with a loss in GSP Plus, that's what we mean by that we don't see any impact, is because there is excess demand and excess requirement, which still needs to be fulfilled. So, those factors, as well as I think other factors that we discussed in terms of, retailers moving away from places like China, they're diversifying their, diversifying from single destination sourcing. All of these factors will positively contribute to fabric mills. So that is why even in the unlikely event of GSP plus removal, the fabric mills to a large extent would not be impacted.
Yes, just adding to what Divya said, I think we covered in the last presentation, when Sri Lanka previously lost GSP plus, TEXILE, for example, through their strategic clients actually went ahead with additional capacity expansions as well. So given the strategic buyers in place, we don't expect the GSP plus removal to impact their production or sales.
Okay. There's another question from Darshana Nakana Dala. The question is, significant personal loans and housing loans taken with the interest rates would remain low for the next 3 to 4 years. But CBSL gave a totally different vibe. I feel that if the interest rates to move up in the banks, NPL and appetite for new loans would go down. So demand for houses, new construction would be limited. Would this impact negatively in the long run? I believe the question is with regard to the recent revision of the policy rates. The trend, basically, the central bank increased the policy rates by about 0.5%. So the question probably is whether they're asking whether this will affect the housing loans in the long run, and whether it will affect the construction sector and the tile sector. Yeah.
So let me just take that question. First of all, this 50%, 50 basis point increase was not unexpected. We'd already forecasted this year the interest rates to increase by around 50 to 100 basis points or so. It's just that the timing was a couple of months before we expected it. So interest rates have been at a historic low, and we didn't expect it to continue for 2-3 years. We were expecting a gradual increase when there's less liquidity in the market and credit growth picks up. So we have seen a pickup in credit growth over the last couple of quarters, which fueled this. But still, housing loans are still at very low rates. So I think that 7% cap plus, I think it's a PLR or PLR plus 1 following which is still very low compared to historical figures. So we don't expect this policy rate hike to really impact the demand for lesser housing loans or hamper the demand for renovations or house builds as such. And even next, so we'll expect a slight increasing interest rates going forward in terms of PLR, etc. But we don't see it being too significant to hamper that demand for housing projects and renovations.
Okay. There's another question also, probably in line with the interest rates also. Apart from that, the question is, there is a shortage of other raw materials like cement, and prices have gone up in steel. So would that have an impact on the tile sector?
So as I said, yes, aluminium sector, yes, the prices have they're impacted and the profits came down. But the tile sector, the clay, etc., is not imported; it's locally sourced. The imports are in terms of LPG mainly. Packing material doesn't contribute too much to the COGS. I think energy costs is around 24%, out of which LPG is a proportion, and LPG costs have gone up by about 40%. But the increase in COGS has been offset by various cost-cutting measures and efficiencies brought in to the production process, as well as cutting down of various other expenses in terms of admin costs, etc. So they're managing the margins by looking at the various other efficiencies. So even if the price LPG prices increase, yes, they'll look at increasing those efficiencies. But if it increases above a certain point, obviously they can look at certain price revisions, because that's what's happening in certain other industries, like aluminium, for example.
Right. There's another question on the percentage of, what is the percentage? This is from Leela Ratna Pereira. What is the percent of export of Lanka Tiles in its turnover?
So as I mentioned, Lanka Tiles through its Mosaic JV, there's around 50 million revenue per month. So that's about 150 million per quarter. But in terms of the total revenue, it's not significant. So percentage-wise, it's not significant. And in terms of they're running at full capacity, so there's a case being made for expansion there, but it makes more sense to expand the production for the local market because the margins are higher.
Okay, right. So I think we have answered quite a lot of questions that you all had. We believe that you all must have got a good insight about all these counters. We felt it was the right thing to do by splitting the two presentations and give you enough and more idea about all of these counters and answer all these questions. So the whole idea of these presentations, the webinars that we are doing is not to just go and buy, but based on what the investment advice is just recommending. Of course, the Capital Trust investment advisors are very knowledgeable about our research, but we believe that as investors, you all also should be educated about each and every counter that you all buy. And we believe that rather than just purely buying and selling in the market, we believe that you all should invest in a company, looking at its business model and believing in those companies. So with that note, I would like to end the Q&A session. So back to you, Pani. Thank you, everyone.
Thank you.
I would like to thank Hasita, Divya, and Shehan once again. Since there are no further questions, I would now like to close the webinar. On behalf of Capital Trust Research Private Limited, I wish to extend a sincere thank you for our staff for organizing this webinar and for our valued clients for your participation. Hope to see you at our next webinar on next Saturday at the same time. Thank you very much. Have a nice day.